Aloha, everybody, and welcome to Introduction to Cryptocurrency Taxation. This is the latest webinar presented by the Digital Currency Innovation Lab, or DCIL. My name is Ryan Ozawa, and I am a community engagement consultant with the DCIL. The DCIL is a partnership between the State Division of Financial Institutions, DFI, and the Hawaii Technology Development Corporation, or HTDC. And the mission of this great partnership is to help the state of Hawaii explore economic opportunities brought about by virtual currencies, as well as gather data through companies admitted into the program to help guide legislation. And in fact, there is a bill working its way very treacherously through the legislature right now. So for more information about this program and all of the other aspects of it, please visit the HTDC website at htdc.org, and you can look for the DCIL under programs. So this webinar is part of the DCIL Presents series, and it's offered to educate and raise awareness around virtual currencies. Today, we're excited to be welcoming a number of professional experts in the topic from Friedman LLP. It was founded in New York City in 1924, and this session will provide a high-level overview of cryptocurrencies and how cryptocurrencies, NFTs, and various tokens are taxed, and what the future holds for the industries, as well as what tax consulting advisory services Friedman offers. Starting off today's presentation will be Stephen Baum. He's partner at Friedman LLP. He contributes to projects spanning a range of industries, including digital currency, emerging technology, software, telecommunications, and consumer products. And we'll also be hearing this morning from his colleagues, Cody Lau, senior consultant, Connor O'Shea, audit manager, and Matt Belenke, who is the senior at Friedman LLP. And before we dive in today, I'd like to remind everyone that this session is being recorded and will be sent to those who registered for this webinar, as well as posted on YouTube to share with others. And more importantly, you're welcome to start now sending in your questions during the session through the Q&A function that's separate from the chat function, and we will address them when we have time at the end of the presentation. So without further ado, I will get out of the way and welcome Stephen. Stephen, please. Welcome to the webinar, and please take it away.
All right. Good morning, I guess, to everybody in Hawaii. We are based out of the New York time zone, so it's afternoon for us. So I'm on my second cup of coffee. But good morning to everybody there on their first. We're going to go through a PowerPoint presentation today to kind of walk everybody through a little bit about cryptocurrency and how it's being taxed. I know today is April 6th, so in the US, April 15th is tax day. This year, that falls on a Friday, which is a holiday, so it will be April 18th. But if you've traded digital currency throughout the year, and you've reported or have realized gains on the transactions of digital currency trading, whether that's purchasing NFTs, trading Bitcoin, or swapping Bitcoin for Ethereum or other digital currencies, those are taxable events. And that means you will owe tax on those on the due date of April 18th. Even if you file for an extension, you are still required to pay the tax liability on that date without having to, take on any sort of penalties or interest from the IRS. So we'll walk you through all of that today. We're going to go through some other areas around DeFi and different things we've seen over the course of the year. And please make sure you're, putting your questions in the chat. I will do my best to kind of answer them live if I can. Otherwise, we will take about 15 minutes at the end of the session to go through anybody's questions that they have. All right. So to start here, I will, give a brief introduction to the team and what they specialize in, and then I will kind of hand it off here to allow everybody to kind of do their sections of this PowerPoint and break this down into a little bit more detail. Ryan had given me a nice warm introduction. My name is Steve Baum. I'm the practice leader of the digital currency practice at Friedman. We specialize specifically in auditing and accounting around digital currencies. We work with a lot of individuals, companies, and a variety of other types of entities to work with them on reconciling digital assets as well as auditing digital assets. So if the IRS or any other parties were to look at them, they would have peace of mind that the digital asset reconciliations are done appropriately. Connor O'Shea is a manager in the group. He specializes in primarily auditing of digital asset and digital currency companies. Cody Lau is our senior associate, head of our consulting practice as well. And he works primarily with our high net worth and white glove consulting practice to help individuals reconcile digital assets trades for their tax returns. And then we have Matt Blanky as well, who is a JD and a senior tax associate, specifically assisting in tax interpretations and evaluating rules such as staking income, is a fork, how are those treated? Matt handles a lot of our tax interpretation work with a lot of our clients. So I'm going to be passing this off to Connor. Connor will start with a high-level overview and introduction to digital currency, and then we will be passing it on through our group here to get a little bit a deeper dive into the digital currency taxation.
Awesome, thanks, Steve. Before we get into it, just a quick disclaimer here: we are not registered investment advisors. Nothing that we're talking about here today should be construed as investment advice. As with any kind of investment, whether it's crypto or otherwise, you should perform your own research before investing. So before I really dive into, we really dive into the taxation aspects of cryptocurrency, I wanted to kind of just discuss crypto at a high level, talk about some of the definitions that you would hear, if you're participating in this industry. So, cryptocurrency is a general term. It's used to describe a new class of assets that have been emerging over the last decade or so. It's generally referring to a set of technologies that's utilizing a cryptographic encryption to perform payments or to transfer value over a network. A lot of these networks are supported by a decentralized group of people, meaning that no one person or entity can really control the technology. You'll notice the word crypto is in there, and really what that's referring to is, like I mentioned, the cryptographic encryption that goes into, essentially custodying the assets. And what that means is you need a specific passphrase, which is also known as a private key, in order to send the value across this payment system. And so the private key on a technical side, it's an alphanumeric string of letters and numbers, which can also kind of look like a passphrase. It's a set of words. It can either be 12 or 24 words that, using a mathematical algorithm, can actually hash into this long alphanumeric password. And what that means in this payment system is that you have your own private key. It essentially means that you are able to custody your own assets on this network, and that no single person or entity or any kind of regulator or overviewing company or operation is able to take those assets away from you, so long as they don't have access to the private key, right? You'll hear all the time in crypto, your keys are the most important. If you lose your private key, the crypto is gone forever. If somebody steals your private key, then you're at risk that somebody could steal your crypto, and none of these transactions are reversible. So that's something else that anybody in the industry probably knows pretty well, is that once a transaction is on the blockchain, it's very, very rare extreme cases that would be able to be reversed. And generally, even present day, things like thefts, things like errors, there's no centralized authority that has the power to go in and reverse those transactions. So a question we get a lot is, where are a lot of cryptocurrency transactions held, and where are they recorded? And the answer to that is that it's on the blockchain, right? So that's also a very general word, but generally what that means is it's a transactional history that is usually publicly available in the most cases of cryptocurrencies that are common today. And it records all transactions from the beginning of time. And what a lot of these network participants are doing, this decentralized group of people that I talked about, they're working to validate all these different transactions and maintain a number of independent copies of the record. Meaning, if one of the people who carries a copy of the blockchain, they have issues with their computers, they have a power outage, their computing equipment is destroyed, there's still a large quantity of other histories out there. A lot of the time, or most of the time, all these decentralized individuals are reconciling against each other's copies of the blockchain to make sure that they have the most up-to-date copy of all these transactions. A lot of these transactions are publicly available. There's tools out there that you can use to query the blockchain in order to get a history for a certain address or my history. For example, if I wanted to put my address into one of these query tools, I could go look at all of my history of transactions. You'll hear digital currencies, you'll hear digital assets, crypto. It's generally all referring to the same thing. The IRS refers to it as virtual currency. Matt will get into a little bit about those virtual currency questions that you see at the top of the 1040. And cryptocurrencies can be stored a couple of different ways. They can be stored in wallets, which is usually a software or a hardware that the individual controls. So like I can control my own wallets. A company can have their own set of wallets. You can also hold it on an exchange. So Coinbase, FTX, these are big name exchanges that have been very popular and gaining popularity and getting a lot bigger over the last couple of years. They are places that you can send your crypto or send dollars and buy and sell crypto. These services, a lot of them will hold on to the crypto for you as you're buying it or as you're selling it, and then you have the opportunity to withdraw it or send it to another person or send it to another address or company or person. The other option is with a custodian. So there are some services out there that say, hey, we will custody your crypto for you. A lot of these, this is more institutionally focused, is where you see the custodians coming into play. There's usually a fee associated with that. And there's a lot of trade-offs between, the accessibility, how quickly can I access my crypto versus my security. There's wallets that can be totally disconnected from the internet altogether, which are obviously more secure than me hosting a wallet on a computer, which is susceptible to a hack or damage to my computer. One of the best obvious, cryptocurrencies out there is Bitcoin. That's, the one that everybody's really known about, but there's thousands of cryptocurrencies out there. Some obviously more value than others. Some, had great intentions and never really took off. And then there's a lot of really awesome projects that are up and coming. The main other cryptocurrencies that we generally see a lot of are Ethereum, Litecoin, Ripple, Bitcoin Cash. But there's hundreds of others that, our team and, people in the industry are seeing on a regular basis that are either up and coming or they've been established as good projects. So transacting in crypto, right? So there's a couple of different ways you can transact in crypto that trigger different types of capital, that trigger different types of taxable situations. So Matt's going to go into a little bit deeper dive into where exactly it's reported and what triggers these things, but high level, right? Buying and selling crypto, trading crypto in order to, earn more money over time. That's all capital gains related, similar to if you're buying and trading equities, right? You can buy and hold for the long term. If you see this as a long-term investment, you can buy and hold, and maybe at some point down the line, you wind up selling to cash. That could be potentially a long-term capital gain. There's also ways to earn, active and passive income that would be kind of categorized as ordinary income. So mining, for example, crypto mining is the process of verifying the transactions of other individuals in the network. And without going into too much detail, if you operate, if you have a mining operation, you are rewarded a small amount of cryptocurrency for validating the transactions of others. So there are a bunch of different ways that you can transact and earn money. And again, obviously, anytime you're earning money, you wind up having taxable transactions. One of the questions that we get a lot is around the valuation of cryptocurrency, right? Especially for tax purposes. How do I know how much dollars I make, right? I can't tell the US government, hey, I made 6 Bitcoin, right? They're not going to take a cut of your Bitcoin. They need to understand, businesses and individuals alike need to be able to convert their cryptocurrency activity into dollars. So if any other accountants out there, there's a distinction between kind of GAAP accounting and accounting for IRS purposes. I'm going to focus on the IRS aspect right now. So there's a lot of different prices for crypto at any given time, right? So these exchanges that I talked about earlier, they all kind of operate as different marketplaces. And, although they all generally track in the same way, there are, most of the time, there are slight differences between the trading price of the same asset across different exchanges. Obviously, basic economics, if there's an arbitrage opportunity, theoretically, somebody's going to go try to capitalize on that arbitrage opportunity, and the prices are going to get closer together across these different marketplaces, pretty quickly. But that creates confusion in the industry. Hey, what is the price? If there's multiple prices at any one time, it's obviously tough to say, hey, like what actually is the price that I should be using here, right? One of the pieces of guidance, one of the limited pieces of guidance that the IRS came out with in 2019 is they basically said there's a number of different accurate representations, right? They do allow for you to use kind of an index. There are price aggregators out there who will kind of take the price of a bunch of different marketplaces across the industry and kind of make an index out of that. Or, you could look at one specific exchange. If I do all my activity on Coinbase, maybe it makes the most sense for me to use the prices that Coinbase is reporting as far as the valuation. There are a lot of really great open source tools out there and free tools to be able to get pricing information regarding cryptocurrencies. That goes for the fair market value. And then on the peer-to-peer transaction side, if I'm, for example, selling my crypto over to Cody, and where maybe I'm going to give him Bitcoin and he's going to give me Ethereum, we need to use those tools to figure out, hey, what is the dollar denominated amount that this transaction is happening with, and that's what we would kind of go in and use some of these aggregators for. So from here, I'm going to pass it off to Matt, who's going to dive into some of the more some of the taxable transactions and what guidance is out there, like I was mentioning earlier.
Yeah, thanks, Connor. Hi everyone, my name is Matt, and just going to get into some of the taxation virtual currencies and other tokens that are related to it. A big thing that happened was the IRS notice 2014-21. And basically, the IRS adopted what the Financial Crimes Enforcement Network, aka FinCEN, they adopted their approach in stating that although virtual currencies operate like real currency, and they're a medium of exchange like real currencies, they do not qualify as a currency for tax purposes, and thus they're taxed as property. And the IRS also stated that in computing income, taxpayers must include the fair market value, which Connor alluded to, the fair market value of the virtual currency, which is measured in US dollars, and as of the date the virtual currency was received. That's one of the key things.
Matt, just to go over so everybody's clear about that, what that means. Connor talked about this, that digital currency is traded 24/7. So unlike traditional brokerages where it's easy to grab a closing price or a final price of the day, there is no close price, there is no spot price for crypto because it's traded on so many exchanges and it's traded 24/7. So the key to fair valuing, if you have a lot of activity happening in digital currency, is to pick a methodology that you can apply consistently, right? So if you have, let's say, mining income or staking income, and it's happening every single day, right? And it might be different times during the day. I don't think the IRS would ever expect, you to get a specific second or minute that would be needed for every single transaction, but to apply a consistent methodology is the key here to kind of make sure you're reporting it appropriately.
Yeah, thanks, Steve. And kind of piggybacking on that, so disposing cryptocurrencies, when they're disposed, they would be subject to capital gains losses, so possibly short-term, long-term capital gains and losses. Receiving cryptocurrencies in exchange for services is considered ordinary income, and you would calculate that by, for example, taking the amount of coins multiplied by the fair value of the asset at the time earned. And another big announcement came last year where the IRS issued a memo where it basically concluded that swaps of certain cryptocurrencies, they can't qualify as tax deferred like-kind exchanges under Section 1031. And under Section 1031, taxpayers may defer tax gains when they sell certain property and reinvest the proceeds into similar property, hence the like-kind portion of that section. And for exchanges occurring on or after January 1st, 2018, the Tax Cuts and Jobs Act, the TCJA, limited the availability of Section 1031 exchanges to real property, so excluding all other property, including cryptocurrencies, as a result. And two of the biggest, I guess, guidance and guideposts for legislative history from the IRS for the crypto industry are Notice 2014-21 and the revenue ruling, which came a couple years ago. Notice 2014-21 was big in that it basically announced that payments made using virtual currencies would be subject to withholding information reporting. And as I noted, crypto will be treated as property. Despite the sort of real currency qualities that it has, similar to what FinCEN found, it would still be property. So another sort of big portion is income from crypto mining. There are different ways to, so if a taxpayer, he's mining cryptocurrency or virtual currency, it would constitute a trade or business. And the mining activity is not undertaken by the taxpayer as an employee. The net earnings that the crypto miner would earn, they would constitute self-employment income. And he would be subject to self-employment tax as a result of that. So where do we file crypto taxes? This is sort of the big question. And over the years, the IRS has become a little bit more forthright with mentioning and discussing crypto and being more explicit with where to look and on what specific forms. And Form 1040, the first time was in 2020. They made mention of crypto, and basically in 2021, they updated the language right on the first page, so you can't miss it. And they explicitly asked, at any time during 2021, did you receive, did you sell, exchange, or otherwise dispose of any financial interest in any virtual currency? So that would include the aforementioned Bitcoin that Connor was discussing. It would be Ethereum, Litecoin, what have you. Any type of virtual currency would qualify there. Form 8949 is the other key one to keep an eye on. Cryptocurrency, all transactions that you would be involved with, whether it's between people or sort of businesses or what have you, they should be reported there. And capital gains and losses, which is the whole purpose behind Form 8949, would also go there. Short and long-term transactions would qualify, and you would report basically whether the transactions are reported on Form 1099B, and Coinbase, Kraken, certain other platforms also qualify as the exchanges that you would use in that scenario.
This is an important thing to notice here is as we continue to get more developed in the digital currency space, you're starting to see more exchanges report under the 1099B rules. As part of the latest infrastructure bill, this was one of the areas that they've been focusing on. The government is trying to get more exchanges to report under 1099B, which is what you get from a brokerage account. If you have a Charles Schwab or an E-Trade account, the end, they'll give you your 1099B report, which will track cost basis, gain on sales, and those things where you could just upload to your tax return. Some exchanges are starting to do that. However, be very cautious with the 1099Bs if you're relying on them, because a lot of exchanges do not have access to your cost basis of digital currency. So if you did not purchase the digital currency on that exchange and instead transferred it to that exchange will allocate your basis at zero, meaning that any trade hypothetically could be overstated. So you could actually end up paying tax on a higher realized gain than you really should be. That's where you really need to understand what's in the 1099B. Is it accurate? Don't just take these forms and trust them. Talk to your accountant, look at your transaction activity, and make sure that it kind of all makes sense. for you before just taking the realized gain and loss from these forms, because a lot of the protocols that they're using and the softwares they're using are still in beta form, and they have not yet been fully tested or vetted for accuracy. So this is definitely an area to talk to an accountant about to make sure that those forms make sense if you even receive them. Most companies do not even issue. Coinbase does not issue 1099-Bs, and most exchanges do not issue these, which leaves the taxpayer alone to try to figure out on their own how much they made on transacting in digital assets. And if you do have transactions in digital assets, it is required to report those gains and losses on 8949. And you can either put a detail of all transactions, you could summarize them up into short-term versus long-term gains, and then put an attachment. It really depends on how much detail there is there and how much trading activity you've had.
Yeah, thanks, Dave. Before I hand it off to Cody, the previous slide mentioned revenue ruling 2019-24, and this was also sort of a key moment for the IRS in terms of providing guidance regarding hard forks and airdrops. These may be buzzwords that you've heard in the news or otherwise, but the IRS kind of delineated and gave their own definition for these terms and kind of basically tweaked what other either agencies were doing, but mainly there was a lot of overlap. And IRS defined a hard fork just from a high level perspective, just so you sort of understand what it means, is when a cryptocurrency on a distributed ledger undergoes a protocol change, resulting in a permanent division from the existing ledger. So typically 2 tokens, for example, of cryptocurrencies could result as a result of a hard fork. And a famous one happened in 2017 when Bitcoin split into BTC and BTC Cash. And sometimes these happen for various reasons. The BTC Cash split was as a result of sort of a disagreement with sort of protocol between parties and wanting a sort of new technology involved, and that happened as a result. There are also soft forks, and according to the FAQs that the IRS gave also in this revenue ruling, a soft fork occurs when a distributed ledger undergoes a protocol change, but it doesn't result in a diversion of the ledger as opposed to a hard fork, right? And the other term that I wanted to touch on before moving on was what an airdrop sort of is at a high level. Many times airdrops are used kind of as a marketing ploy to sort of get more users involved or to get more notoriety or recognition. But they are at a high level a means of distributing units of cryptocurrency to the distributed ledger, addresses of multiple taxpayers, right? So multiple people are getting these either tokens or currencies, and usually it's free. And the benefit for the person or the protocol sort of airdropping it is marketing, right? It's more name recognition, sort of brand building. And in the revenue ruling, the IRS kind of focused on dominion and control, quote unquote. These are sort of the analysis that they looked into for whether an airdrop would be taxable to an individual, is whether they sort of had dominion and control of the tokens or the cryptocurrencies that they were receiving as a result of it. Cody, if you want to take this, or I'm happy to do it too.
The legislation or the outlook right now?
Yeah, legislation.
I can jump in here. So I think as far as legislation, it's a very evolving, ongoing process. There's obviously a ton of different regulators, a ton of different, state, federal, and that's just looking at the United States, right? So there's definitely a concern out there that certain provisions may hurt cryptocurrency, meaning that certain legislation would hinder the development of the industry and be adverse to the kind of the goals of a lot of the industry participants, right? There's a lot of coordination and research going on. So, the people on this panel, plus a lot of other individuals, both at our firm and other firms, we're engaging in a lot of dialogue with these regulators. And so they are definitely, their ears are open. They're working to figure it out. But the development of appropriate regulations is going to be a slow process. And but we're happy to get on with them and discuss with them as they're working through this, as are a lot of other accounting firms, as are the industry in general, whether it be accountants or other participants. There's some ongoing legislation right now. There's a case in Tennessee around staking, where basically a couple is suing the IRS saying that their staking income should not be taxable. That's something that's evolving right now, but it's definitely going to have an impact on a lot of people based on what we've seen so far in that staking, for the most part, a lot of individuals and companies have considered it to be taxable income. This ruling could really change the way that a lot of companies and individuals do their accounting around staking. There's also I think Matt mentioned this earlier in the presentation, the Build Back Better Act. You mentioned this earlier, right, Matt?
Yeah.
So right now there's no, as of 2020, there was no specific legislation stating that a wash sale would apply to crypto. So in the traditional equities market, if a wash sale occurred, an individual would have to eliminate the loss from that sale and, basically reestablish that basis. That way somebody couldn't, inappropriately harvest a loss. So these are all things that, we're keeping an eye out for. The industry in general is keeping an eye out for. But it's a very evolving industry, as I'm sure anybody who's in the industry can say. And, even Steve, Matt, Cody, and I, we've been in the short time, not the short time, but in the time that we've been in crypto, a lot has changed since we first started working in crypto back in 2015. So from there, I'll hand off to Cody. You're on mute, Cody.
How's it going, everybody? So I'm going to be just touching base on some of the outlooks for cryptocurrencies in the future. As you could tell, with the market cap increasing, things really have taken off. We're currently sitting at a market cap of all of cryptocurrencies over 2 trillion. Back in November 2021, it reached somewhere around $3 trillion. So it's definitely on an upward trajectory to keep growing. You can tell just because we have a whole new generation of people who are digital native. These new digital native generation should adopt a digital asset approach or a cryptocurrency approach to their investing, to just their daily lives. Through this, you can as well see companies like MicroStrategy and Tesla that are starting to explore having crypto within their treasury and on their balance sheets. You also have brands and companies like Nike and Adidas that are engaging with NFTs and crypto communities. Going forward, financial institutions are starting to build out their own departments and practices for this to provide customers with access to cryptocurrencies and other digital assets. So you have companies like PayPal, Fidelity, Silvergate, and so on that are allowing people now from a retail level to gain access. In addition to that, you're having actual countries and nation states exploring the use of crypto and CBDCs as well. So one of the biggest examples of a country adopting Bitcoin is El Salvador, who's considering or has implemented Bitcoin as a legal tender. They've also been looking to establish miners to use their currently to explore CBDCs. And to give a little bit of background, CBDCs are central bank digital currencies. I'll go a little bit into depth on that on the next slide, but I think that is on a project with cryptocurrencies. Some of the new emerging trends within the space, just because everything moves very fast. You have smart contract blockchains. So as Connor mentioned, something like Ethereum, which is one of the first smart contract enabled platforms. But in addition to Ethereum, we're growing their market cap extremely quickly over the last few years. In addition to the smart contracts, which allow for a variety of new applications, things like NFTs and DeFi have really blown up. So NFTs are non-fungible tokens. These differ than your other virtual currencies or digital currencies, such as Ethereum, Bitcoin, whereas one Bitcoin is equal to one Bitcoin. There are a technical argument. Otherwise, these NFTs are unique tokens that can't be replaced with another one of the same token. A few of the different applications for NFTs really go into art. So one of the biggest things you'll see on this screen is the Bored Ape Yacht Clubs. Those NFTs are probably one of the most talked about in the mainstream, as well as new users of crypto. So that's a way that art is kind of integrating with NFTs.
I think we're
also seeing an expansion of play to earn or gaming type NFTs. Some of them will include games like the Wolf game on Ethereum, you have DeFi Kingdom on Harmony, and you have Krabata on Avalanche. Those essentially, you use your NFT in a game to earn certain rewards for completing missions, for completing certain tasks. There's a little overlap with NFTs when it comes to NFTs and DeFi. So there are certain platforms that utilize the underlying standards of NFTs in order to create financial products. So DeFi really is this new open financial system that aims to disintermediate financial applications for individuals. The goal is really to reduce the amount of trust that's needed to interact with different counterparties. And the idea is to grant everybody as much access to these financial markets as possible without putting any obstacles in the way. Within DeFi, there's a variety of different activities that you can perform. As you can see on the screen, you can borrow different assets, you can lend your assets out, you can trade in and out of different assets or different cryptocurrencies. You can provide liquidity, and some of the different protocols that allow you to do these things are Aave, you have Compound, you have Uniswap, SushiSwap, which are decentralized exchanges. You have Yearn, which is kind of a yield aggregator for people that provide liquidity and want to farm yield from that. And to close off this slide, the other new emerging trend is these central bank digital currencies. I'd like to kind of caveat that they're not really crypto native. They are more private consortium type chains that are controlled by the government. So while the chains might be somewhat public, there is a government control over it. So it's not as decentralized in the same way that the other cryptos we were referring to are. Next slide, Connor.
awesome. Yep.
Yep, so this next slide, there's really, to summarize, there's really no authoritative guidance from the IRS currently for NFTs and DeFi transactions. To keep in mind, we try to make as analogous situations as we can. So anytime there's a real world situation that we can kind of point to and make that connection, we'll do that. So for instance, if you're earning any kind of yield or income, those can be subject to ordinary income taxes. As Matt and Connor mentioned previously, if you're swapping in and out of crypto, those can be capital gains, subject to capital gains taxes. But the best thing to do is really to consult with your tax accountant if you're unsure of what the situation might be and how you should be reporting it. When it comes to NFTs, there are certain instances of taxable events. So as you can see on the slide, if you're using dollars to purchase an NFT, that is not a taxable event, just the purchase of it using dollars. But if you are selling the NFT $2, or if you're buying an NFT with crypto, those will trigger taxable events where you.
Did we lose Cody?
Yeah, I can keep going on this topic.
Awesome. Yep.
Yeah, so from a high level, right, we're talking about minting NFTs. So minting kind of refers to the process of, for example, turning a digital file into a crypto collectible or a digital asset, and it's typically on the Ethereum blockchain. as is the process for fiat coins. When a manufacturer mints a physical coin, the process of uploading a specific item onto the blockchain would be known as minting. So that's what, when we talk about US dollars to buy or mint an NFT, that's what's happening there. As Cody was saying, NFTs sold to US dollars or crypto, that would be a taxable event, right? And despite having very little IRS guidance, although they are sort of becoming more detailed and more involved in the space, given the 1040 notices and given the hiring process in the IRS has also increased just to focus on this sector in specific. So clearly there's a demand for it. Commonly traded NFTs, they may be treated as collectibles under the 28% tax. And the collectibles falls under section 408 of the Internal Revenue Code, and it kind of encompasses a lot of different things: alcoholic beverages, works of art, rugs, antique stamps. And because each NFT is unique and is considered different from others, those that are similar works to art or other collectibles, they might be treated as such, right? And subject to the 28% tax. And that's where they're kind of swept under the 28% rather than, for example, the 28% or the 20% capital gains.
Awesome. Thanks, Matt. So where does Friedman come in? So our Friedman LLP, as Ryan introduced us earlier on the call, we're I think up to about 700 employees, maybe a little over 700 employees in total. Our crypto practice specifically is comprised of about 50 CPAs, CISAs, JDs, developers that are focused solely on digital currency, whether that's audit, where we work with a lot of large corporate entities, the tax side, which is kind of what we're here talking about today. We also do accounting for business and individuals, more of an accounting services type offering for a wide array of individuals that are participating, NFT collectors, DeFi participants, and then on the corporate side, funds, venture capital, exchanges, mining operations, staking operations, just a very wide array of different clients that we've had the privilege to work with over the last couple of years. So one of the main services that our team here offers is kind of a white glove consulting and other advisory service for high net worth individuals that have very complicated crypto activity. So, in a situation where and it is very common in the industry, transferring assets between platforms, which is very, very common. I think there was a question about that in the Q&A. A lot of the times the cost basis doesn't transfer over. So if I buy a cryptocurrency on an exchange and transfer it on the wallet and then transfer it from the wallet to the different exchange, the cost basis of that cryptocurrency doesn't follow the cryptocurrency. So when I ultimately sell that crypto, it's very difficult to understand what the cost basis of that was based on the information in these platforms. And that's where we come in. So we work with a lot of individuals who are engaging in large trades across different platforms, across different exchanges, to help them reconcile and accurately generate those 8949s and that 1040 income that is required in the United States for IRS and for state filings. There are a lot of tax softwares out there. A couple that come to mind are Coin Trackers, Zen Ledger, TaxBit, Luca. There's a lot of softwares out there that are geared towards individuals and companies to help them create, and reconcile all these different transactions. But, the two areas that they have difficulty are those areas of tracking cost bases across platforms, but also, around the tax treatment. And because, there isn't necessarily a lot of guidance out there. A lot of these softwares, while they're great in relatively simple situations, it can get very difficult for them to interpret tax guidance and apply that correct accounting within that software. So these are all, services that we're able to offer. If anybody, you know, after the call, where our information, I think, is on this next slide here. Yeah. So, you know, our information is here. We would love for anybody who's interested in talking more to reach out. We've been involved in this space for a really long time. So even if we're not maybe the right individual or the right team that can help you, it's likely that we're connected with somebody who could help you. So I'll stop there. Thank you everybody for joining today. And I think we do have some Q&As I see Ryan's popping back on camera here. We'll work through some of the good questions that came up in our chat.
Absolutely. Thank you so much. I mean, I'm going to have to watch this video again. And if anything, it's a disincentive to become a high net worth individual for me. It seems so complex. So I really appreciate you and your team's efforts in breaking everything down. I do want to point to the Q&A function in Zoom, lower right-hand button. And some of the questions that were asked actually were answered in writing during the webinar. So you might want to check there to see if your question came up too. But in terms of questions to address live, I see that Stephen queued one, which seems very specific. So I will ask on behalf of Shane Wolf, from an accounting perspective, are there specific blockchains that appear to have a great advantage over other blockchains? So, well, let's just start with that. Are you tracking all of the different blockchain implementations and kind of getting a sense for which are better for clients and which are not?
Yeah, so I flagged this one because I think it talks a little bit about a discussion. Some of the other questions that were there, I did answer if they were kind of clear answers to give you guys the written response. But on this one, we work with hundreds of blockchains, and Cody could probably go into more detail on how they all work. But, there's no right answer to this. There's no better, there's no worse. They all have unique use cases to them. And I think depending on what you want and how you want to use it will depend on what type of blockchain you would be, more attracted to or more interested in utilizing. The Bitcoin blockchain is a proof of work blockchain that really has the staple of kind of a store of value, of the ability to kind of hold an asset and allow it to appreciate. While you have Ethereum, that's a little bit more of a transfer of information type of blockchain where you could move things around or create value on the network utilizing non-fungible tokens or some other sort of smart contract type of analysis done. And then there's like a Zcash, which is like a privacy coin that allows you to transact through a private blockchain. There's a token out there called Mana, which is a NFT that allows you to purchase a digital land in a certain metaverse or a world. So there's a lot of different blockchains depending on what you're looking for. And there's all of these different things, will provide different types of value depending on the user.
That's excellent, although, it falls in that category of do a lot of research, and it seems that there's going to be another 100 new blockchains in the next year for sure. I want to jump to a question from Todd, which is one that I have. I don't understand how the IRS can justify a taxable event when you buy an NFT with crypto. Should a taxable event be limited to only crypto to fiat or fiat to crypto? Is there any movement to change IRS rules so that they make more sense?
Yeah, I don't think you're going to get this one to change. So, the IRS has been pretty strong on this stance since the 2014 release that if one digital asset is used to purchase another digital asset, then that event is the change of one piece of property for another piece of property. And in that scenario, it does create a taxable event where you would create a step up or a step down in basis for the new asset purchase. So in the example of an NFT, if I have one Ethereum and my Ethereum is worth $1,000 when I purchased it, okay, but then a month later, I go to buy an NFT that's valued at $1,500, and I use that same Ethereum because now Ethereum is valued at $1,500. I've now made $500 in taxable income, and I have a basis of my NFT of $1,500. So the IRS has been pretty strong on that, and it's hard because a lot of people, especially in 2021, saw the rise of crypto occur. They bought all these NFTs, paid a lot of tax, and now everybody's sitting on a very high basis of their NFTs which may have value in the future or may not have value. But the reality is when they sell those NFTs, they'll either create a further taxable event of more income, or they'll create a loss. Will they be able to deduct that against future income moving forward?
Even if it wasn't actually traded in at any point for US dollars.
Correct. It does not have to be traded for US dollars.
That's
You can go in and out of crypto or NFTs, and it's considered taxable.
And it's so volatile too. I mean, the spreadsheets would make me dizzy. August is asking, and this would be a question you can answer as you are a nationwide practice or an international practice, in fact, is Wyoming, which I've heard about as well, is Wyoming a good case study regarding legislation? Have you encountered any complications with filings from Wyoming LLCs which treat crypto as untaxable private assets?
So Matt, I'll let you answer this. I'm not as familiar with the state and local rules in Wyoming. We have a department that handles specific state and local issues. So I don't know the exact answer on Wyoming specific regulation there. Matt, do you know that?
Well, I mean, the huge advantage that Wyoming has is that they're sort of trying to become the Delaware for crypto and blockchain law, right? What corporate law is to Delaware, Wyoming is trying to establish, and they've succeeded in doing so. So there are very sort of favored structures surrounding crypto that are within the state, especially around DAOs recently. That's become sort of the hot topic, but also sort of being a custodian bank for cryptocurrencies and crypto clients and companies. So there is a onus that the state legislature has put on being sort of the go-to state for crypto and legislation and sort of the development of laws. So in that sense, they are sort of the leader among all the states in having more forward-thinking laws, and it'll probably continue to go that way, I think, in the near future.
Excellent. A very reasonable question from Mark. Is there a value or range or volume of selling that you would recommend someone shift from doing their own taxes to bringing on a specialized crypto accountant?
Oh yeah, I mean, here's what I'll say with that. Okay, you know, we deal with a lot of different people. You know, a lot of the people that come to us are, you know, typically in the 7-figure plus trading activity, because that's when they start to get really concerned about, am I going to be flagged? But the problem is just because, you know, you have maybe only like you know, a 5-figure gain or something like that, you could be flagged, and that penalty could be material to you in the future, right? So I think what it comes down to is, if it's over your head and you don't understand what you're doing, you have to get somebody involved to help you, right? Because that's where you can ultimately get yourself in trouble. And I don't think it necessarily is a number. I think it has to do with, if the gain on crypto is becoming a large percentage of your net worth, or, you know, what you are worth, it's worth it to have somebody look at it for you.
Very good advice. And actually, here's a related question to what you had just said. If one of my investment fails completely and becomes worthless, how do I write it off if the cryptocurrency is illiquid?
Matt, since we've been talking about this all week, I'll let you take that one.
I might have to defer.
The short answer is, we don't believe it's allowable. So as of right now, unless you sell it, right? Unless you get rid of it, meaning unless you sell it or dispose of it in some way, there is no deduction. So even for lost or stolen property, the TCJA rules are making it very gray as to whether or not stolen property is eligible for a deduction.
Oh, interesting. Yeah, because I mean, you almost hear now as much people losing their shirts as you hear people getting rich. So that's that is very.
But the stolen property is not eligible for the deduction. But if you stole it, you have to pick it up as income.
Good to know. I'll keep that in mind. I think one last question, and we can wrap it up. In a self-directed IRA beyond self-dealing, what should be avoided for crypto?
So I don't want to get into financial advice as it relates to, you know, what assets to buy if you're going into an IRA. So I'm not going to, but, you know, I would obviously, if you're going to put something into an IRA that's kind of self-directed, you know, stick with the more well-known coins. You know, don't put something into a very, new project or something that you don't understand. And then the second thing is make sure you understand what you're doing, make sure you understand, the projects you're getting involved with in a deeper manner than just somebody on Twitter supported it.
It's trending on Twitter. It must be legit. Excellent. Well, I'm sorry to say we've come to the end of a very informative and dense session, and I feel like I need to go back to school. I'd really like to thank Stephen, Matt, Connor, and Cody for their time today, and of course Friedman LLP in general for making all of these clearly valuable resources available to us here all the way out in Honolulu and Hawaii. I hope everyone attending, learned as much as I did. A quick reminder that yes, the session has been recorded, and if you registered, you will get a link to it in your inboxes. You can also search for it probably within 36 hours on YouTube, and it'll come up. So again, thanks, Stephen. Thank you, everybody, for joining us today, and we'll see you at our very next webinar. Mahalo.
Thanks.
Thank you, everyone.
Thank you, guys.